There are a wealth of factors that have been built in. There's just tremendous negativity in the market. You had the worst quarter in a decade. You had the worst December since 1930. Valuations are pretty interesting right now. They're 14.5 times earnings. So today you had a little bit of relief in terms of better news out of China. You had better news on the trade front and better news out of the Fed and good news on the U.S. economy. So those are all good. The market is spring-loaded at this point, and we think you saw last week a 1,000-point up day. You saw some significant down days. At inflection points in the market, you're going to see a lot of volatility, and at some point, that volatility is going to be on the upside.
Right. Jim, let's talk for just 1 second about these swings. I mean, another day where we're seeing, a 3.5%. It's not just that the points are big, the percentages are big. A lot of people will say, it's algorithmic trading. It feels almost like Twitter mobs that form out of nowhere and come to a decision one way or the other, every 30 seconds and then move on. What do you think about all of the big swings we've had?
I do think that there's been an influence from computer-based trading and rules-based strategies that has led to an increase in volatility. If you look out, though, over the medium term, the markets will follow fundamentals. The growth picture in 2019 still a little bit uncertain. We want to be putting money in areas where we think we're going to be compensated for the risks. We think high yield is an area that looks particularly good today in that sense. You look at the sell-off we went through from the end of September to Christmas Eve. The market was down 20%. High yield was down 6%. Look at today's rally. The market's up 3.2%. High yield's up 1.6%. So gives you some downside protection, but also some upside participation.
Yeah, David, speaking of high yield, I mean, that's basically a proxy for risk in the market, too. So anyone who thinks a recession is coming should stay away from these parts of the market. We had gotten pretty high on recession odds for the last couple of months, but it was mostly just the sentiment data. Even a different version of the PMI gauge this morning looked better for the U.S. David, do you think a recession is in sight?
We don't think so. We think the U.S. economy is good, but the earnings are going to be slowing. It'll be slowing down some. The real wild card is international trade and tariffs. If that's resolved, we think it's going to be a very good economy this year. Not a recession, not as robust as last year, but a very interesting thing. If you look at earnings growth of the S&P 500 and S&P 500 returns, there's a near zero correlation. And that means that your earnings growth is not your primary determinant. It really is PE, inflation, and interest rates. So you can have slow earnings growth. You could have 5%, 10% earnings growth and a very good stock market.
Jim, yesterday we were all concerned about Apple and sort of the question mark it put in front of earnings as we go into that season and what the guidance will be like. What's changed? I mean, we know that the Fed is going to reevaluate its policy, but in terms of earnings, I mean, David had mentioned that there's no correlation. But it seems like the markets are really hanging on what the guidance will be for 2019, and we are yet to get that guidance. We're waiting for those conference calls.
Sure. So I'd give a reminder that we're in the pre-earnings season. So this is when the warnings come out of companies that will miss, and we go through this every quarter. There is some information content. When you have a company like FedEx indicating that global trade is slowing, Apple indicating that the consumer in China is also slowing, that is some information content. But we don't think we're leading to an earnings recession in 2019. So we do see earnings growth in the, say, mid-single digit level for the year.
All right, finally, Jim, on the inflation point, this was a big topic of discussion, throughout the morning. Why is it that the economy can be this strong, that we can have 312,000 jobs this late in the cycle and still see no inflation, or are the wage gains going to ultimately point that way?
No, we've had a theme for 3 years now called stuckflation, which is that the impact of technology bringing supply into industries prevents pricing power from taking hold. That's also happening in the labor market. So you can also look at the inflation break-evens. The market's not worried about inflation. That's why you can have a little bit of an uptick in the wage gain number today, and the market's not particularly concerned.